Morning and Jai Hind. In this video, I am going to start a new chapter, provisions and reserves. Uh, Whenever it's time for distribution of profits among the shareholders, some portion of the profit should be kept in the business for meeting the known as well as unknown liabilities in future. This is done by making provisions and creating reserves out of current year's profit at the time of preparation of final accounts. So, whenever we make a provision, just like we have seen in our previous chapter that we have learned how to make provision for depreciation, in that all the depreciation amount is to be transferred to the provision account, and it is helpful in finding out the current price or market price of the asset at any time during its life, and it also helps in replacing the older assets with the new one. And one more thing which is important here is that this kind of liability, whatever it may come in future, we cannot determine the exact value, we cannot determine the exact amount, that how much liability is going to occur in future. And for those liabilities which we know that which those liabilities are going to come or going to occur in future, but we cannot determine the exact value, for those liabilities a company used to prepare or make provisions. Now, let us see examples of provisions. We usually prepare provisions for the various other purposes, just like in case of assets, we used to prepare provision for depreciation. We have seen this in the last chapter. For providing tax at the end of the financial year to the government, we used to prepare provision for taxation. Provision for bad and doubtful debts is prepared for meeting the uncertainty of not paying or not receiving the debtor amount in future. And provision for discount on debtors, we usually provide discount to debtors whenever there is a prompt payment done by our uh, uh, clients. So in that case, there is a provision which is prepared by a company to motivate them to make quick payments. And last one, that is provision for repairs and renewal of assets. As I've just told you, that whenever that suppose if we want to replace our asset after 5 years, so for the coming 5 years we have to make the provision, we have to collect the required amount which are going to arise after 5 years for the replacement of that asset. So we have to get prepared from today only. So for that we have to prepare a provision. So these are various types of provision which a company used to make. Now let us see the characteristics or features of provision. Provisions are made to meet a known liability. That means it is obvious that we know or company know about the liabilities which are going to occur in future, but the exact amount that is not known, the exact amount of that liability is cannot be determined with reasonable accuracy. We are not sure that how much amount of liability is going to appear after a specific time in future. but we are sure that there would be some liability which are going to happen, so we must be prepared for that. And the third one is provision is a charge against profits, and as such reduces the profit of the year in which it is created. Obviously, before calculating the net profit, the provision is charged. That means it reduces the net profit which is going to appear in our financial statement, and that loss which actually occur would be written off against such provision. That means our net profit won't get affected much in actual case. Now let us see the purpose or importance of provision. The first one is to ascertain the true net profit of a business. So for calculating the true net profit, it is very important to consider all the expenses, whether it is paid or outstanding. And as we know that provision is also a kind of expense or loss for a firm, so it must also be considered while calculating the net profit. Then only we can find out the true net profit of a business. Next purpose is to ascertain the true financial position of a business. So whenever we consider all the anticipated losses and expenses which are going to occur in future, then only a company could calculate or could know or determine its true financial position. Next is to provide for known losses in the future. So as we need funds to meet up all the losses and liabilities that are likely to occur in the near future, and for that provisions are made to meet those kind of losses. And the fourth one, for the equitable distribution of expenses. That means if suppose if we have a asset which has a life of 5 years, so for that 5 years lifespan the expense is distributed equally for each year, so that the burden is shared or distributed equally for the whole life of that asset. And it is very obvious that initially the charges of repair and maintenance are less, but the burden on the later years are increased because of repair charges and maintenance charges. And with this I am going to end my video. Thank you.